Hello and welcome back to the channel. Mortgage bonds moved higher this morning after the Fed's latest decision and a fresh batch of economic reports. Here's what actually matters for your mortgage rate and the housing market. First, the Fed left its benchmark rate unchanged at 3.50% to 3.75%. They didn't cut, but they also didn't hike, even though three members wanted a small increase. Chair Kevin Warsh made it clear the Fed is still committed to getting inflation back to 2%, but they're going to stay patient and make decisions based on the data, not on any preset schedule. Now, the really encouraging part: inflation continues to move in the right direction. The latest PCE report, the Fed's preferred inflation gauge, showed headline inflation dropping to 3.7% from 4.1% over the past year. Core inflation, which strips out food and energy, also edged lower. Even better, shelter costs, which make up a huge chunk of inflation numbers, came in calmer than usual. There's also some technical changes coming to how inflation is calculated later this year that should make the numbers look even better moving forward. All of this is the kind of progress that eventually helps bring mortgage rates down. On the growth side, the economy is still expanding, but it's slowed a bit. Second quarter GDP came in at 1.5% annualized, below what economists were expecting. Consumer spending is holding up, and business investment, especially in areas like AI data centers, is strong. But overall, a cooler growth number combined with easing inflation often creates a more favorable environment for interest rates. Jobless claims remain relatively low, which shows the labor market is still solid but not overheating. So what does all this mean for mortgage rates and housing? Mortgage bonds are testing some important levels today, and the 10-year Treasury yield is sitting in a neutral zone. When the Fed is on hold, inflation is trending down, and growth is moderating, it typically takes pressure off mortgage rates. We're not expecting a sudden big drop, but the direction looks more supportive for rates than it has in a while. That could mean better news for homebuyers trying to lock in a purchase and for anyone considering a refinance. Bottom line: the Fed is staying data dependent, inflation is moving in the right direction, and the housing market is getting a bit more breathing room. If you're in the market for a home or thinking about refinancing, now's a great time to talk to a lender and see where rates are for your specific situation. They can change quickly. Let me know in the comments. Are you planning to buy or refinance in the next few months? Drop your thoughts below and I'll see you in the next update. Thanks for watching.